Welcome to this explainer. Today, we're going on a seriously fascinating journey into the math and the survival tactics of modern investing. We aren't just looking at how to make a quick buck when the sun is shining. No, we're looking at the exact structural engineering required to make sure an investment portfolio survives and even thrives when the sky is literally falling.
Take a quick look at your own investments for a second. We all like to think our hard-earned assets are totally secure, right? But here's the absolute critical question. Are your quote-unquote safe investments actually safe? Or are they just perfectly calibrated for a normal world, basically waiting to shatter the exact moment things turn upside down?
To answer that, we really have to talk about the primary threat out there, and that is the black swan. Now, this is a concept heavily studied by Nassim Nicholas Taleb. A black swan is basically this extremely unpredictable, highly improbable event that unleashes absolute havoc on the market. Think about the 2008 financial crisis or, a sudden global pandemic. It's these massive, unpredictable shocks that truly govern our financial world, not the quiet, boring days in between.
Okay, let's dive into this. Here is our roadmap for today. We're going to start with the threat of black swans, then look at what it means to be fragile, robust, or anti-fragile. From there, we'll compare classical versus robust optimization, see how they survived the 2008 crash, and finally, figure out how to actually build anti-fragile portfolios.
Fragile, robust, or anti-fragile? Let's take a look at how systems actually behave when they're put under extreme stress.
Now, you might be thinking the opposite of fragile is just being robust, meaning you can take a punch. But minimizing risk really isn't enough. Taleb argues that true anti-fragility is having a mathematically convex response to stress. So what does that actually mean? Well, think of fragility like a glass teacup, right? Drop it, it shatters. Robust is like a rock. Drop it, it stays exactly the same. But anti-fragile? It's like the mythological hydra. You cut off one head and two grow back. A fragile system has this concave response, breaking and losing big time when volatility hits. But an anti-fragile system, it actually has a positive sensitivity to volatility. It literally gains from chaos.
Moving on to Section 2, Classical versus Robust Optimization. Let's see how we transition from this high-level philosophy into the actual data science of building a portfolio.
Since the 1950s, the gold standard has basically been Harry Markowitz's classical mean variance optimization, or MVO. Now, this efficient frontier maps out a really elegant mathematical attempt to maximize your profit while keeping a strict upper limit on your risk. It's searching for that absolute, theoretical, optimal portfolio. But there is a fatal flaw here. It relies incredibly heavily on exact, known parameters. It operates under this huge assumption that past averages and historical variances are going to perfectly predict the future. And as we all know, the market rarely just repeats itself exactly.
And that brings us to what data scientists call parameter uncertainty. See, traditional models are deeply fragile because they blindly trust their initial inputs. It's honestly like trusting a weatherman who confidently promises it'll be exactly 72 degrees tomorrow, so you pack nothing but shorts, only to walk outside straight into a blinding blizzard. If the model's underlying mathematical assumptions are just plain wrong, the whole optimized portfolio completely collapses under the pressure.
And this brilliantly illustrates the solution: robust mean variance optimization, or RMVO. Instead of pretending we have some magic crystal ball, RMVO directly builds uncertainty right into its core mathematics. It uses this min-max approach. Basically, it mathematically plans for the absolute worst-case scenarios across a huge range of possibilities, and it optimizes for that. Sure, it sacrifices a tiny bit of peak efficiency during the good times, but it weaves this massive, mathematically sound safety net for when things go bad.
Section 3, Surviving the 2008 Crash. To really grasp the difference between these two frameworks, we have to look at a real-world stress test during one of the most catastrophic black swan events in modern history.
Now, what's really interesting about this slide is the allocation behaviors right before the 2008 financial crisis. If we look at a portfolio targeting a 1.5% risk level in January 2008, the classical MVO model dangerously concentrated its bets. It threw nearly 38% of its entire weight into EOG and almost 25% into Apple. It was totally hyper-optimized based on past sunny weather. But the robust model, the RMVO, because it assumes parameter uncertainty, it spread its bets widely across dozens of assets in much smaller, diverse, and safer allocations. It didn't try to guess the one perfect winner. It prepared for widespread failure.
And here is the exact moment the market collapses. The blue line is our classical MVO, and the red line tracks the robust RMVO. Now, when the black swan hits, both of them drop steeply.
I mean, you simply cannot completely hide from a global crash. But look closely at the recovery. That red RMVO line doesn't fall quite as far, and because it preserved more capital at the absolute bottom, it bounces back significantly faster than the blue MVO line. The robust portfolio actually survives the initial shock so it can fight another day.
Let's put some numbers to that pain. During this specific 2008 data test, the classical MBO portfolio took a devastating 53% loss, dropping its balance to the absolute lowest point. And guys, a loss that steep leaves an investor completely financially paralyzed. I mean, it literally takes years, sometimes decades, just to mathematically compound your way out of a 53% hole. The robust strategy, on the other hand, absorbed that initial blow way better and kicked off a much sharper upward trajectory post-crash. It totally proved its resilience.
Interestingly enough, the thesis data also revealed a pretty stark contrast when it comes to the types of black swans. When researchers tested these models against natural disasters, like Hurricane Katrina back in 2005, the markets barely flinched. Both models actually recovered in a matter of days. But anthropogenic disasters, human-made financial crashes like 2008, those cause drastic, prolonged market destruction. And that is exactly when having robust engineering is absolutely non-negotiable. Which brings us to Section 4, building anti-fragile portfolios. So how do we pivot to practical resilience? How do you and I actually go about measuring this stuff and building an anti-fragile framework into our own strategies?
First things first, we have to measure something called strategy decay risk. Basically, this is the subtle but very real erosion of a strategy's effectiveness as the market environment shifts right beneath our feet. A really fantastic diagnostic for this is minimum regime performance, or MRP. Instead of just looking at average returns over time, MRP zeroes in on a strategy's absolute worst risk-adjusted performance across totally different historical environments. It is the ultimate stress test. It gives us a true fragility score by establishing the absolute lowest possible bound of durability.
Faced with uncertainty, the only thing that is certain is that our assumptions will be wrong. So, the crucial point here is that traditional optimization minimizes risk based on a perfectly predictable mathematical model. But if that model is wrong, you are entirely vulnerable. Over-optimizing your portfolio for one single perfect economic scenario literally guarantees failure when a black swan inevitably shows up.
So, what's the fix? Well, a highly practical solution derived from all these concepts is Taleb's barbell strategy. Check out this allocation. Notice how it completely eliminates that fragile middle ground of moderate risk, which, let's be honest, usually gives inadequate compensation anyway. Instead, you're putting 90% of your assets into hyper-safe conservative instruments like treasury bills. That basically guarantees your absolute survival. Then you take that remaining 10% and allocate it into highly speculative, long volatility assets with massive upside potential. You are entirely capping your downside, but keeping yourself exposed to those convex, anti-fragile gains.
Uncertainty in the global markets is an absolute guarantee. We all know that. But as we've seen today, through the math of robust optimization and the barbell strategy, vulnerability is a choice. So when the next black swan hits, and for sure it will, is your portfolio going to break under the pressure of its own rigid assumptions, or will it be positioned to recover, adapt, and actually grow? How fragile is your framework? Thank you so much for joining me for this explainer, and I'll catch you next time.